Hello traders, welcome to FreeeFX. My name is Francesco Sani and this is my educational channel for Forex and other asset classes. So today is the 10th of February 2006, Wednesday, and it is nearly midday GMT. So we have a lot of things to talk about really since my last video, which was the 7th of January video, which was entitled 2006 a bearish year. Basically, it covered a lot of topics and it was quite a long video. So today is an update on what's been happening and where we should look at for trends, opportunities, and a commentary on the current situation in various asset classes. So I'd like to start with a standard disclaimer, which is just for your benefit, really. So trading foreign exchange carries leveraged risk and the possibility of financial loss. So just remember that anything you see in a video, it's up to you whether you want to follow it, the advice, so to speak, or suggestions or hints, but it's really up to you how you put those into trades and risk your own money. The topic of the day, therefore, is risk aversion, ? And I think it's quite important to look at that and try to gauge where we are in terms of this across different asset classes. So I'd like to just quickly close that. And I've prepared a number of charts, but they've not been overly overlaid with lines and various indicators. So the only thing I tend to have on charts is fundamental trading and analysis, real volume where available, which it is. This is market scope provided by FXCM, and this is the retail volume. So it's limited to retail volume from FXCM, but considering the large turnover and the number of retail clients they have, I think it's fair to say that it is fairly representative of a large portion of the retail crowd worldwide, because they have obviously offices around the world. And so this isn't just the American clients or the British clients, it's across the globe. So it's quite, if you're a retail trader, it does give you a sentiment idea of where most people would be positioning when there is a certain movement in the market, how much strength is there behind that movement. So I'll keep that. Sometimes I also have the ATR, the average true range, just to gauge sort of if there's a dwindling range, just to see how much excuse me, how much we've moved on that particular day, averaged out across the last X number of periods in terms of open, close, and range for the day. So these two are the only ones I have, and then occasionally I will actually draw some other trend lines or channel lines and some levels. But as you can see, I always try to start with a fairly clean chart if I can. Sometimes I actually delete charts, and so I have to start over again, which is annoying, but that's how it happens sometimes. So I'd like to start with the conversation with the Euro USD because it sort of draws people in by its nature being such a liquid pair, and everybody, especially new traders, because of the low spreads also, but because it's the most talked about pair, and they almost just, it's inevitable that they'll start with the Euro USD. It feels safer because it's so liquid and the spreads are so low, and everybody talks about it. There are tons of information about both countries generally and their financial affairs and what sort of and the currency pair itself has been analyzed obviously for a very long time. Now the euro has not been around for very long, so when you look at the chart of the euro going back to 2001 when a single currency was introduced, you see that we start from a very low level here under 0.19, and it appreciated a lot. So since the single currency was introduced, the optimism and investment that attracted, boosted the pair to the levels that we are now back to many years later. So all the progress that's been made has been undone. But prior to that, there wasn't a single currency. So when we compare like with like, okay, we compare this level here, 1.12 something, with this 1.12 down here in 1993, it's the same level. Okay, so we're actually what was quote-unquote support, or there was demand for European centered currencies against the US dollar. Back here, now we're in the opposite situation where we're actually below that level. So in all this time, decades, we've actually come back almost full circle. Okay, and now you can draw your own conclusions from that. Very difficult to make decisions based on these rather large historical patterns, but really it is quite significant to think that the levels at 140 up here, the level of 110, okay, are historically matched through different decades. So, and also down here obviously at 0.80. I would really try to concentrate, however, on slightly less historical ranges, just because we are having to draw some conclusions and we don't have hours. I want to keep this into perspective and keep it relatively short. Might go into the half an hour today, but so the Euro USD at the moment, we have mentioned these sort of historical ranges, but if we look at the more recent range, we can see that, well, I've done this analysis lots of times, so you can look at past videos, so I won't go into a lot of detail, but you can see that there is a descending top there and there, and this is the bottom. So we've sort of bounced off this bottom here, but we've not really gone far, and this means that that there hasn't been a lot of progress. If you compare the movement here from 2010, yes, it was a retraction, but then it sort of solidly moved forward. In a space of time, you can see here, we've not moved further up. We've really just come back to where we started. And we didn't see that here. There was this spike and back down, but this was a much shorter time period. So I think we have a problem in that the Euro USD, if you look at it in a more zoomed in fashion, for 2015, this is your 105 level. Okay, we're looking at okay, the bottom here is from March 2015, and almost exactly a year, because we're into the 10th of February. This is the 13th of March 2015, so we're just 1 month short. And since then, we've really stayed down at the 105 a couple of times, and once again in December of 2015. And we bounced off the 115 level, which is where this range kind of started back in February 2015. So if we look at it from basically January, we've been under 115 and above 105. So these two levels have been what we've been at. And the only time we came past the level was during the Black Monday so-called market crash in China on the 24th of August. And that pierced upward towards 117, but then it actually closed at 116. And then the next day it came back down, and it never went above 115 since. So that was an extraordinary day, and it didn't really play with fundamentals, and it was an excessive move that was quickly retracted. So in essence, essentially we have a 1,000 pip range for an entire year, which means that it hasn't been a very good year for trending for this pair, and we are now left in a situation where there is a lot of uncertainty regarding the euro, but also some uncertainty regarding the US dollar. Okay, so we have the US dollar, which is our next. So I'm going to close this because we won't refer back to it again. And if we look at the US dollar here, I've got two charts on the go, and here's the US dollar with the Euro US dollar below. So we have a sort of contrasting view. Now the US dollar chart here is the trade weighted FXCM US dollar index, and this is a basket of currencies measured against the dollar. So the dollar against the euro, pound, Kiwi, Japanese yen, and the Australian Aussie dollar, I think. So it's an average view of the positioning of the dollar against this basket of currencies. So, but the euro US dollar is obviously one of the, I think it weighs the heaviest on the on the US dollar index. So the movement of the two is highly correlated. Obviously, inverse correlation is the given here. But you can see that when in 2014 and then 2015, early 2015, the US dollar was moving up because the euro US dollar was moving down. And yes, we've had inverse correlation since, but more recently, okay, this correlation has gone a little bit amiss because obviously this draws on other majors, not just the euro US dollar. But also I think it speaks to the uncertainty of this correlation, particularly euro correlation to the US dollar. And what's more significant is that this movement has been quite choppy. And yes, we've had rises where we've had falls, and the recent fall in the US dollar was driven by the rise in the euro US dollar. Now, the euro US dollar has been rising mainly not just on the back of the US dollar weakness here, but also has been rising because of the euro short positioning. The consensus is that once the carry from 140 was expended, when we got down to these levels of 104, okay, that's thousands and thousands of pips. There was nothing much left. It wasn't pushed anymore. So it sort of rose as far up as these, as I said, 115, 105, 115. But this 1,000 pip range has remained. When we look at the dollar, from 11,600, you rose to 12,300. Okay, and that means that the US dollar has actually risen more than the euro US dollar has stayed still. Why? Well, if you look at these levels here, when this pair bottomed, the US dollar topped at 12,100 roughly. We've come back to these levels now, but until late January, we were pushing higher to 12,300. Okay, so we were actually breaking above this by 200 pips, slowly but surely. So if you try to build some kind of trend lines around the Euro USD, you'll find that they were sort of potentially doing something around here, but then it broke through any potential trend line to the upside. The US dollar, on the other hand, has genuinely been progressing steadily. So we're at the bottom currently of a trend. So the line would run from May 2015, and then June would be the first bounce, August, maybe not September, definitely October, maybe not December, but definitely February. So if this is a trend line that holds, technically speaking, some positioning from commercial trading might take advantage of this, or rather non-commercial trading will take advantage of this, and this might rise once again. Whether it will be progressing, we don't know, but certainly this is a useful chart comparing the two. Now I want to see also the US dollar against another pair, which is the gold. So XAU USD. Now I've put the two on top of each other, so I've overlaid them. So the blue line is the US dollar now, and the candles would be the gold against the US dollar. So you can see the inverse correlation. Now there's been a lot of excitement about gold recently. Now this level I've drawn in pink is the 1,200. Okay, 1,200 is this massive line that I've drawn in because it goes all the way back to here. If you can see down in 2009, end of 2009, beginning of 2010, there was a big move away from the 1,200 and back to 1,100. Okay, so $100 difference, and then it broke through eventually in 2010, and we stayed above it since. It bounced off it 2013 and in 2014, and beginning September 2014 again, And then finally we broke through definitely in the middle of 2015, and we're coming back up towards it. Okay, so basically that means that we are interacting heavily with this level, and it's one to watch. I would say, however, that this rally in gold isn't particularly made of substantial belief that the precious metal has what it takes to be the funding element for risk aversion. So the topic of today is indeed what shape will risk aversion take? And we haven't seen it in Euro US dollar, we haven't seen it in the US dollar yet, because there haven't been such strong moves that tell us in these particular instruments that they are currently the already sort of been identified as the safe havens for a risk aversion scenario. In other words, if assets that are rich in premium and leveraged up to the hilt are starting to break down, and significantly so, as the year progresses, as we saw in January, then something must replace them. And usually protecting capital is priority number one when it is impossible globally, because of sentiment, to find one investment medium that gives you capital protection because of high volatility to the upside or the downside because of swings, etc. So you may want to protect your capital, so maybe park some capital in a safe haven investment like bonds or US dollar backed assets, and gold being another one. Now obviously if the US dollar became the safe haven of choice and it rose significantly in the next few months, we have a March rate decision coming up, so then the gold run would be short-lived. And we have come up to this big level, and this is the daily chart. You can see that if we sort of zoomed into it, okay, now you can see that there's been a sort of steady downtrend, and the top here, if you drew a line from here, sort of 1,500 roughly down to 1,400 roughly, and just below 1,400, then 1,350, 1,300, 1,250, 1,200, let's say. Okay, so you could join some of these tops and make a channel or a top trend line, and we are just kind of bouncing off that, and this means that the level that we're looking at the moment is not only the top of that line, of that trend line, but it's also the 1,200 level, and we have today and yesterday bounced off it. So how much we can gauge from that, it really depends on which safe haven will be chosen, whether it's gold or US dollar. But certainly at the moment gold has enjoyed this run, but I don't think it's long-lived, because there's this kind of channel, and we just bounce off the bottom and we bounce off the top again, and it's just following its downtrend channel. It's a downtrend, remember, so there's plenty of scope for gold to fall further. If you can see where we came from, if you go back to when the US dollar was unpegged from gold in 1971, and then gold rose, and then this was the 1980 crisis of the Iranian Revolution and the storming of the embassy, the American embassy in Iran, and the high oil prices and inflation, and gold rose by $600 in that month. So we haven't had a swing of that size, and that wasn't going to last anyway. So, but these levels anyway are there. Okay, so we have certainly scope for gold to fall further. People have been calling for gold to fall to 1,000 last year. It hasn't done so, but we came close to it. And this was 1,050 back in November 2015. Okay, so basically between the end of last year and beginning of this year, we've had sort of these levels, and so I think it's not unthinkable which means that the US dollar might actually be the strongest candidate. Now, we have to look at that for a moment because we have on dailyfx.com we have the calendar for the central banks, and you can see that we have a number of central bank releases coming up, and I'd like to sort of concentrate on that for a moment, if you may, because the Federal Reserve Bank obviously is coming up on the 16th of March with its own rate decision, which means that it's very important today, especially the reason why I'm releasing this video today is because later on, in about less than 3 hours, we'll have Chairwoman Yellen speaking to the House of Representatives in the United States Parliament. So we have the attention of media and money managers on the wording and her answers. We don't know the questions, well, I don't anyway, I'm sure some will know, but we don't know as the general public what questions she will be asked. And it'll be interesting to see what the reaction, not so much what she'll say, but the reaction of the market, if there's anything that she says, which is interpreted by the market, not us, but the market's moves on the answers that she gives on particular topics. There will be undoubtedly links made between the real economy and the financial markets. So there will be things that may touch upon the value of the US dollar, maybe things that touch on the interest rate and what it means for the American economy, and also the reaction of the markets. We don't know. So it will be very interesting to hear what she'll say. I don't know if she'll have people with her sometimes. For example, the Bank of England's governor just recently had a hearing with the Treasury Committee and in the UK, and he had people with him from the Bank of England to answer questions on particular topics or comments to be made. So I'm not sure if she'll be by herself, but certainly it'll be interesting to hear what her own answers are. I'm sure that she'll have plenty of things to say. Now, so that this is really preparation for what might come in March. It might even be discounting what the March rate decision will be if she gives too much away. So she may not want to do that in case she's hoping to keep some of that power until the March rate decision, so not to give too much away. Although she wants to prepare the markets, not to scare them, but she also wants to maybe keep some of that premium. There's not been a mention of the US dollar being overappreciated, I don't think, is on her mind, but it's certainly interesting to hear. Now, in February, as you can see, we've had a Bank of England rate decision, and we've had the Reserve Bank of Australia rate decision, but March is packed with rate decisions from all the major banks. We've got the Fed on the 16th, but before that we have the ECB on the 10th, and this will be a big driver for a lot of currencies if Draghi, as he said, is wanting to step up possibly on the pace of quantitative easing in March, or introduce even further stimuli to try to push inflation, because he believes that there are some negative forces at play on inflation worldwide, and he thinks that they're holding back these mechanisms that the central banks are putting in place that should be working, but they're not. So 17th of England, 17th of March, Bank of England rate decision. We have the 15th, Bank of Japan and Reserve Bank of New Zealand on the same day as the ECB rate decision, obviously later in the day. So a lot of these rate decisions are really important for us. So I'm just going to have a look at these in a second, but let me just go back to our charts here. So I was talking earlier about the risk aversion scenario, and my sort of unwitting mentor at a distance, because we don't really know each other, but John Kicklighter, of the chief strategist for dailyfx.com, he is someone who I have been inspired by, and I have listened to, and whose videos I have been following for more than a year, possibly 2 years. And his particular view, which is one that I have sort of come to align myself with as a retail trader, is that there is a risk aversion scenario that has been bubbling up for all of 2015. The S&P has been in trouble. The S&P represents to him, but also to a lot of people, when you look at it in his perspective, which is that it represents sentiment for not just US equities, but being the size of this particular index of 500 companies, and the fact that it's been outstanding in performance. If you look at how far it's come since 2009, okay, it's been a consistent winner. And a lot of things have been said about beating the S&P 500 when coming to measure a particular performance, whether it's a money manager's performance, a retail trader's performance, a pension fund performance, or anything at all that's been linked, especially in America, with, say, 401ks that are tracking the S&P 500. A lot of people have made money out of this. Insurance companies, leveraged positioning from all corners of investment areas. So one thing that started happening sort of late 2014 is that we started in 2015, we started seeing this index stalling, okay? And what John Kicklighter does say, and has been saying consistently, is that no matter how big these movements are, and since the fall in August from the Black Monday crash, it has recovered an incredible amount up to these highs. But it struggled, and sure enough, in December 2015 and January 2016, we've seen another crash, and again there was another market scare from China. But it hasn't. This choppiness then led to a recovery, but it hasn't really chopped back up, and it's actually gone lower. And so we're now down to 1,850, which is kind of line in the sand. And today it's been a fairly sort of bullish day, but really it's if you have the patience to watch something like this unfold, and you trade something like this to the downside, you have to be prepared to sit through some large drawdowns. You can't get timing absolutely right on something like this that moves hundreds, thousands of pips and back down, and finally starts to break down, but it won't break down in a straight line. Even these falls, they've been very quick, but then after that, there are periods of consolidation and more. But certainly we can see a drop of, some people say, 10-20%. If you look at how far it's come, from 750, we're over double that, so it's not inconceivable that it might fall to fresh lows from these around 1,800, 1,850. Now, the S&P 500 tracks sentiment worldwide because of its size. So risk aversion, therefore, means that if an asset class like this, an equity index like the S&P 500, begins to crumble, and seemingly there's no more need for any bit of news or for any global scare from China, it just begins to unwind because the money invested in it from money managers in various corners of the financial institutions basically pull out, and that money coming to an end, that supply coming to an end, means this has nothing to stand on. So if something like the S&P begins to fall on sentiment, not on a particular bit of news like China's markets, or just on sentiment, and different managers from different asset classes begin pulling money left, right, and center, whether it's the S&P 500, whether it's the another equity index, or whether it's yen crosses carry trading, or whether it's emerging markets, commodities like oil, anything like all these different asset classes falling in tandem. People get scared because trading is done by people, and even the best and the most funded people are people after all, and they have to make money. So if it gets to a point where holding and hoping don't hold water anymore, and then you look around and everybody around you is pulling out, you have to pull out before it's too late, and you won't be able to fill your orders and cover your losses. So anybody who's watched The Big Short recently knows that if you in very volatile situations, there's very little that markets, even the biggest institutions, can do. They can go down, it can go under, and eventually go bankrupt. So nobody wants that. So the S&P 500 is definitely bearish at the moment. If you go and if you look at the more recent period from the beginning of 2006, this is where I'm pointing, the 1st of January 2006. Okay, it's not really a day of trading so much, so flat. But then look at the 4th of January, first opening of the year, massive candle down. Okay, 2000. The high was 2057 and the low was 1987. Okay, so and then it followed days of falling and days of falling, and down here to the 20th of January, and we are roughly around the same levels as then. But it's just taking a little breather, but this may continue lower, very much so. This means that sentiment is bearish. If sentiment is bearish, there is nothing in the world that can stop it falling. Which means that we don't have anything to hold market sentiment up. No bit of good news. And what people will be looking for is a safe haven, like the dollar. So very important to keep an eye on the US dollar. But what about other majors or other asset classes? Let's have a look at another equities index. This is the FTSE 100, the Financial Times and Stock Exchange 100 shares index. Now this has been in existence since 1986, if I remember correctly. And so if we went back all the way to that time, you'll be able to see where we're at historically with this. Okay, so 1986, we're roughly at the inception here. Okay, so there we are, 1986. So we've come a long way since those times, and you also see that we've had 3 humps, unlike the S&P 500, where the third hump is actually much higher. In the FTSE 100, it's actually been a complete cycle of 7 years each time. Okay, so 1995, 2000, 2002, 2002, 2009, 2009, 2016. Okay, so and each time we've fallen back down to these levels at around 3,000 something. Okay, let's say maybe 3,500 or something. So we have from these highs, okay, come down every time to the same level. This time, seemingly, it looks like it's taken longer, but in reality, if you sort of measure it, from here, let's look to here, that's about 1,600 days, 1,300 days, and 2,100 days. So yeah, they are, irregular in that respect, but more or less, if you go by years, it's 7-year cycles. So it is looking like we are falling back down, and this has an impact on the pound, because the two, as you can see, from this period, which is the Great Financial Crisis, the FTSE 100 and the pound fell in sync. Okay. Sometimes the pound and the FTSE 100, as I've mentioned before, have an inverse correlation, as you can see, for example, in this period where the FTSE 100 was falling and the pound US dollar was rising. Okay, and other times the FTSE 100 rising is not accompanied by pound US dollar rising. In fact, this has a general upward direction, and this has a slightly more muted and even bearish direction. And then we have this period here where the FTSE 100 is stalling and the pound US dollar is rising. Okay, so they're not always a perfect correlation one of the other. Now this final push, let's go more into detail for this year, on end of last year, September, and that was the August market crash from China. And then we've had a fall in the pound US dollar. FTSE 100 wasn't particularly following it in the same streak, but it was nonetheless bearish within this trend, and it continued to lower itself. This particular period of January 2016, this was the 1st of January, and then we've had the two basically streamlining from this point on absolutely perfectly, pound, US dollar, and FTSE 100 down to the end of January. There has been an attempt in a rally in the FTSE 100 and the pound, but the FTSE 100 has continued to fall. And since it's broken that 6,000 level, which is a significant level, it's really pushed lower every time. So it's bounced off it a number of times. Okay, if you look at 2009, it was pushing against the 6,000 several times. Sorry, 2011, it was pushing against the 6,000 level, and 2012 eventually broke through, but didn't go very far, up to 700 something. So, and we're now back below. Has been pushing on this level from 2015, and finally started breaking through properly, and now we're below it. So we have the potential for, in the risk aversion scenario, you can see that this is primed for a fall back to these levels, and it's starting to drop significantly in the past few days, and the recovery looks very uncertain, especially with two of the major top three companies from the FTSE 100 being BP, British Petroleum, and Royal Dutch Shell having had immense losses. I mean, Royal Dutch Shell has been held up by I think its size, but certainly BP has had enormous losses. I was reading recently that in the last year it's been horrendous compared to the previous year where it was up considerably. So it speaks of the oil collapse, and we don't have to be if we overlay that with oil, let's do that, but just to see visually how the two correlate. There we go, oil. So that's the price in blue. And now if FTSE 100, we can get rid of the pound here now, possibly. Okay, you can see in blue the correlation between the FTSE 100. Now there's mining companies. There are mining companies as well in the FTSE 100, and technology, and but really the oil has really hit hard. So it's been falling from these levels, 2014, 2015. Okay, and then it recovered, and then it fell significantly from these levels down to where we are now, below 30. So if you look at 2016, okay, let's do 2016. You can see 2016 how oil and the S&P have been almost tracking one another, in sync. Okay, it obviously the sync started before, but the more dramatic recent developments have really taken the FTSE 100 below the 6,000 once and for all. So risk aversion hits commodities, hits equities from different parts of the world. So you can see already two asset classes that are following one another, and then you have other sort of various currency pairs that reflect on this. We covered the pound, US dollar. You have yen crosses. I'm going to add the particular currency pair that reflects this this view, and this is the dollar Japanese yen. Now this is a particularly important one because you can see how much it's fallen in the last couple of weeks. Okay, this is 2 weeks, going from 121, we're down to below 115 and touched 114. Okay, so that's 700 pips pretty much in 2 weeks. And you can see the size of this candle in October 2015. That was when the market crash in China provoked immense losses around the world, and this massive candle for the week that was the Monday, and so the week then it eventually recuperated a lot of its losses almost entirely. It's almost entirely a tail, and then the following week was bearish, but then it sort of recovered from 119, pushed all the way up to 124 almost, and down to 121. So if you look at the bigger picture where we are now, again, John Kickleiter of FXCM says that we have essentially for 2015, 2016 this 116.50, if you like, down here, or let's say 117 even, is a sort of neckline, okay? And we have a sort of shoulder, head, and shoulder. We've got a head and shoulders pattern, which is a reversal pattern. And now some people say that these are not very effective ways of measuring reversals, head and shoulder patterns. But if you look at the upswing, down, up, uptrend, head and shoulders, down, not sure about this one, but certainly we are roughly up at these levels, and it's happened before, reversing from 124. We came to 124, 25 here. The humps here were at 124. This was 126, 125 back in 97. Now these levels have been historically tested, and we've not really broken higher than that since 2007. So we have reason to believe that what John Kikalaja is saying is actually correct. Well, I have reason to believe, not we. I don't work for a company, but certainly I think other people might agree that this is a situation where the US dollar versus the Japanese yen is looking very troubled. Why? Because, as I explained in my video in January, the yen crosses are highly correlated. So you have obviously different levels from which to fall, and the US dollar Japanese yen is quite high. So this is a very appealing short position if you wanted a large correction. Now there's a consolidation period here in 2014, almost the entire year, and these kind of breaks coming from various Bank of Japan decisions, rate decisions, but eventually, even if you came back down to here, just because there was consolidation here doesn't mean to say that you can continue. And if you came down to here, 105, it will still be 1,000 pips from 115. So you make quite a decent return on that short. Some people have been obviously, well, not some people, but there is the concern that a short on dollar yen, unlike other yen crosses, like a Kiwi yen, pound yen, euro yen, etc., CAD yen, especially with the oil fall, may not work as well because you're basically trading two forces against each other. The US dollar appreciating with the rate hikes and the strengthening US economy, depending on who you listen to, but the consensus is that the US economy is strengthening. And on the other hand, you may see that yen crosses are falling, and so risk-sensitive asset classes and instruments with risk aversion threatening to hit full force across the markets, this will capitulate. So some people say, well, we can't really decide which way to go because yes, it's a yen pair, it's a major, US dollar, Japanese yen. The US dollar strengthens. We've seen it before. When the US dollar is strengthening with December, the December rate decision was, I think it was, where was it? The December rate decision, if I can find it. Okay, I believe this was the week of the rate decision here, and it rallied, but then it fell back down. So, and this is probably not particular to the Japanese yen and US dollar pair, but this is really showing that the US dollar rising isn't particularly going to save this pair, because risk aversion means that since basically June of 2015, the tops of these moves have been lower each time. So this is June, July, August, 2 months down the line, November, 3 months down the line, December finally lower, and January. So we have 1, 2, 3 tops to this imaginary line down, and imagine a channel coming down here as well. So whether you call it head and shoulders or a new forming channel or a downtrend starting here, I can see that this is certainly a good move to the downside rather than to the upside. So, and I don't really think it's wise to call US dollar bullishness on this pair, because this represents the carry trade funded by cheap QE from the yen side. So I think the Bank of Japan, with the negative rate decision of late, have tried to stem the flow, but the Japanese yen might actually go up in price, and if Japanese yen goes up, obviously their exports, which they depend on, will become very expensive. So it will trouble them a lot. And the currency wars have been waging across the globe for the last few years, and with central banks unofficially trying to outdo one another with QE programs, the ECB being the latest in a series of QE programs around central banks in the world. But really, the situation is that there isn't enough cash in any bank to stem the flow of capital out of the country or to stop risk aversion. So if this scenario, risk aversion, hits the trade, the foreign exchange rate for US dollar Japanese yen, there's nothing that the Bank of Japan can do. Or they can try, but they're limited. And just like the Swiss National Bank trying to hold the floor on the Euro Swiss last year, I think it was January of 2015, where the markets crashed on the Swiss bank, removing that floor because they could no longer have enough funds to actually stop to keep that situation, to keep to their word essentially. And we saw what happened with the markets at that point. So essentially that's the situation. We have a lot of things that are not right about the Japanese yen being a cheap currency. We have to certainly look at these scenarios as warning signs that not all is well with carry trade and risk sensitive assets overvalued and overappreciated through the years. So this cycle from 2007 to 2015, okay, it's a sort of 7-8 year cycle. I tend to go by the number 7. So if we can stretch a little bit, that's kind of end of 2007 to end of 2014. That's basically 7 years. So we'll go with the 7 years. Some people call it the Shemtar, the Jewish 7-year cycle that's contained in the scriptures and in the Torah and in various Jewish kind of religious counting of the years. The 7-year cycle certainly seems to exist out there. You can obviously interpret around it and make your own conclusions, but we are in a cycle nonetheless, and we've come up to these peaks, and we're seemingly ready and ripe and already started to come back down. So closing that loophole of a cheaper yen seems to be the time. Now, I have other currency pairs I was going to talk about, but I am going to just very briefly mention them because they are my own interests, so they might be of interest. They're away from the affray and the madness of the main pairs and the main trends. We have some crosses, synthetic pairs like GBP and ZD. We are halfway between this point and 195 and 245, which is basically 220. So 220 is the midpoint of this 3,500 pip move between the April of 2015 period and September 2015. Now, 220 is the mid period. As you can see on the weekly chart, we've had these rather ghostly looking weeks from the beginning of the year, where a lot of tails and wicks and very small bodies. So dojis. Essentially, we're on the 5th doji here, which means huge indecision. This pair has not been doing anything. Look at the size of these red candles. Look at the size of these blue candles. If you want to call them green candles, same thing. So huge move here, and I remember the excitement I felt trading this pair to the upside at the time, and I'm incredibly, I don't know how, still bullish on this pair, because this is only halfway through a massive move, and however, there is concern at this point because there's not been a resolution of this uncertainty, and certainly this correction, some people call it an Elliott wave pattern with A, B, C, D, and E corrective to the downside, but within a larger bullish trend. We've come down halfway. 220 is a halfway mark. We're below it, have been roughly for 3 weeks now, closing below it. But these wicks up and wicks down seem to suggest that there's no conviction either side to the up or the downside. Why? Because the pound dollar is extremely indecisive, and the Kiwi US dollar, if we look at the weekly chart, is also quite indecisive. We come down from this very long. So the pound Kiwi has been funded essentially from selling the Kiwi. So the Kiwi shorts have fueled the pound Kiwi more than the pound US dollar. Entirely, almost entirely, the pound the pound Kiwi move has been funded by shorting the Kiwi US dollar. So that in 2016 we've had this very choppy kind of ranging of the Kiwi US dollar. I've called it a double top, looking more short term, thinking double topped around 68 mark, and it's certainly not been a level that's been surpassed. We're still below it, so this recent bullishness has not really got us anywhere with the Kiwi US dollar. So I think if we sort of angle this slightly more gently, we might say that there's a line coming down here, okay, and we are sort of at the top of that line, so that we'll see a continuation to the downside. So the Kiwis had a lot of troubles from the bank, central bank, the RBNZ trying to talk it down to global dairy trade, auction results in Auckland being quite negative for a few weeks now and months. And I think interest rate cuts may be on the horizon in March. So there are a lot of concerns that the Kiwi is still overvalued for New Zealand. Although if you look at the longer term trend, if you see a trend line, if you follow my cursor, this is the first bounce, if you like, and this is the second bounce back in September 2015, and we're still above it just. On previous occasions, like here, it was a pretty strong bounce. Now it's a little bit of a choppy start off it, so we may continue lower. If we did continue lower, we go back down to levels like the 0.60, which would be about 700 pips down. It's a nice move. And if you wanted to go further down, it would go back down to 0.50. Okay, so plenty of scope there for a short Kiwi, and that takes us to the pound Kiwi again, which means that we would have scope to continue further above this. And certainly if you look at the long-term trend line, you might say that we have hit the top of that trend line starting in 2001 through 2007 and 8 and 2015. We bounced off that top several times, and this is no different, so that we may see a continuation lower. But if the Kiwi did actually break to the downside, this could continue higher to these levels that we saw at the top of 2015, okay, to 45, and possibly all the way to 3.0. So that might be the next big target, but these are huge developments, certainly not short-term trades. The euro pound has been an interesting one. I'll just mention it briefly. We've seen how the euro US dollar has been struggling to do anything, but I think the euro pound is a different pair because you've got the euro on the other side of the pound rather than US dollar, and the pound has been struggling. But there's been more optimism about pound, certainly in terms of rate rises, and that's been something that's been feeding the markets in 2003, 2014, and some of 2015 as well, in terms of the Bank of England raising rates. Now that's obviously been discounted. The governor's certainly made it clear that it's not something that's on his mind, raising rates at the moment. I think a lot of forecasters have put it down to 2017 now as a first rate rise from the Bank of England. So that's pushed the pound back a lot, and you can see that how for the beginning of 2016 it's hit the euro pound by appreciating the euro side. But you might say also there's a trend line coming down here. We hit the bottom, and that's the top of that channel. So we're reversing back up to that top, which means that when we get to between 0.80 or 0.85, we should get back to a down move. Part of me wants to believe that that is the case, but part of me actually, because of what John Kicklighter was saying, and actually reading the same on other websites like forexinfo.it, FreeeFX, and forums, I think that I see more this as the euro shorts being covered and sold off. In other words, the euro has been sold heavily for a while, so long-term positioning, big money, huge amounts of money have shorted the euro, and when that money is taken off the table, what happens to the euro? Well, it's not a euro bid. Nobody's buying heavily euro, perhaps just taking money off the table as the new year begins, closing the books. Euro is free to rally back up, but really I don't see this as a continuation move with a lot of strength, so I would be cautious of going long the euro against the pound. There just isn't the fundamental behind it. The ECB is going negative, it's going on quantitative easing, it's doing everything it can to keep the euro down, and of course central banks can't win like we saw with the Japanese bank, but there are a lot of things which are troubling the eurozone at the moment. I think this is a short-lived move. As you can see from this weekly candle, it's already wicked up and almost reversing down to 0.77. I think it's unlikely that this will continue forever, and people get excited about euro bullishness. Good luck to them. I'm not so sure. But certainly short term, this has provided nice trades for people trading the euro to the upside. But I think long term, it's not a proposition to trade against the general trend here. So that concludes my video for today. So I'd like to thank you for listening. And the next video might be in March or further up in February, depending on how interesting the markets get. But there's a lot of juice and a lot of fuel in these markets, and it's sentiment-wise, it's a bearish market developing. So some pairs will benefit from that, other pairs will not. Certainly keep your eyes peeled for opportunities to short things that are going down quick, because they are going down fast, and there are opportunities there to be taken almost once in a lifetime. These big cycles of 7 years or so happen, every few years, and you have to be there to pick them. So don't burn yourselves, but certainly I myself am looking at shorting some of these opportunities. So thank you very much for listening, and I'll see you soon.